What's up, money mavens? It's your boy Iggy from the Investing Iguana, and today, we're diving deep into the CapitaLand's China Trust Annual Report for 2023. Now, I know financial reports can be as dry as a desert, but trust me, this one's a real page-turner. We're going to decode 7 key slides that'll give you an inside scoop on this real estate giant's strategies and financial health. So buckle up, because by the end of this video, you'll not only understand the numbers, but you'll also have a clearer picture of how CapitaLand is positioning itself to capture China's booming real estate market. And who knows, you might even pick up a few tips to help you on your own journey towards financial freedom. Slide 1. This China-focused S-REIT is the first and largest of its kind, boasting an impressive presence across 12 cities in China. With a staggering total asset value, this portfolio means business. Solid metrics underpin this REIT's performance. We're talking about a gross floor area, a remarkable occupancy rate, and a juicy distribution yield. These numbers scream efficiency and profitability. But wait, there's more. The trust has diversified its portfolio across different real estate sectors, including retail malls, business parks, and logistics parks. This diversification strategy is like having a well-balanced investment portfolio. It helps mitigate risks and provides multiple streams of income. Smart move. Geographically, this REIT is spread across major Chinese cities, which are economic powerhouses in their own right. By not putting all its eggs in one basket, the trust reduces its reliance on any single market and taps into various regional growth dynamics. Diversification at its finest. Overall, this future-ready and resilient portfolio looks like a solid investment opportunity, especially for those seeking exposure to the booming Chinese real estate market. Slide 2. As you can see from this slide, CapitaLand has been proactively reshaping its portfolio to capture emerging trends in the Chinese market. They've divested non-core and matured assets, freeing up capital to invest in sectors aligned with domestic consumption and innovation-driven growth. One key move was expanding their retail footprint with the acquisition of PurePlay, a well-located asset targeting the burgeoning middle-income segment. They've also ventured into business parks and logistics parks, positioning themselves to benefit from China's technological advancements and evolving consumer patterns. What's impressive is the strategic foresight demonstrated by CapitaLand. Each year, they've introduced new initiatives to tap into different growth drivers, such as reconfiguring assets to optimize for China's reopening in 2022 to 2023. This agility in adapting to market shifts is commendable and could make CapitaLand an attractive investment opportunity for those seeking exposure to the Chinese real estate market. The slide also highlights CapitaLand's strong track record in acquisitions and asset management, leveraging their deep domain knowledge and comprehensive real estate platform in China. Overall, this diversified and forward-looking portfolio strategy appears well-positioned to capture the real estate trends shaping China's future economic landscape. Slide 3. From the slide, we can see that CapitaLand China Trust has been positioning itself for growth and resilience over the years. Their total assets under management have grown steadily from just $0.7 billion during their IPO to a whopping $4.4 billion in FY 2023. This growth has been achieved through a combination of organic growth, strategic acquisitions, and portfolio reconstitution. One key aspect of their strategy has been to capture China's future economy across multiple sectors and through market cycles. They've done this by acquiring retail assets, business parks, and logistics park properties across various cities in China. For instance, between FY 2011 and FY 2016, they acquired CapitaMall Minshangluan in Wuhan, CapitaMall Grand Canyon in Beijing, and CapitaMall Xinan in Chengdu. From FY 2017 to FY 2023, their focus has been on active recycling and expansion of their investment mandate. This includes portfolio rejuvenation towards resilience, diversification into new economy assets, and acquiring more retail malls, business parks, and logistics park properties. Overall, CapitaLand China Trust has been quite acquisitive, with a total acquisition and divestment value of a staggering $53.1 billion. This aggressive growth strategy positions them well to capture the growth potential of China's future economy across multiple sectors. Slide 4. The slide highlights CapitaLand's key performance indicators for the fiscal year 2023. It seems like the retail sector is making a strong comeback, with a 91.4% portfolio occupancy rate and a whopping 45.8% increase in shopper traffic year over year. Tenant sales also saw a massive 41.5% jump, indicating that consumers are out and about, spending their hard-earned cash. Now, let's talk about capital management. The report shows a stable cost of debt at 3.57%, which is great news for the company's bottom line. Additionally, 82% of their interest rates are fixed, providing a buffer against potential rate hikes. And get this, they've increased their sustainability loans by 31%, demonstrating a commitment to environmentally friendly practices. Overall, these numbers paint a pretty picture for CapitaLand. The retail recovery, coupled with prudent capital management, could make this an attractive investment opportunity. Slide 5. The portfolio consists of 15 properties, ranging from residential developments like CapitaMall Xingnan to commercial and logistics assets like CapitaMall Grand Canyon. While the total value stands at a respectable 24,830 million renminbi, there's been a slight 0.9% dip compared to the previous year. What caught my eye is the varied performance across different asset classes. The new economy assets seem to be facing more pressure, likely due to near-term supply-demand imbalances and location-specific challenges. The retail segment has also seen smaller, weaker assets experiencing a downturn. However, the overall portfolio appears relatively resilient, with occupancy rates and rent growth outlook aligning with market trends. As an analyst, I'll be keeping a close watch on CapitaLand's ability to navigate these dynamics and optimize its portfolio for long-term value creation. The diversification across property types and geographies could provide stability, but capitalizing on emerging opportunities will be crucial. Slide 6. First things first, let's talk about the assets. This company boasts a massive $4.56 billion in non-current assets and a cool $433 million in current assets. That's a total asset value of nearly $5 billion. Impressive, right? But wait, there's more. On the liability side, we've got $367 million in current liabilities and a whopping $2.21 billion in non-current liabilities. Add those up, and we're looking at total liabilities of $2.58 billion. Now, here's where it gets really interesting. The company's net assets, calculated by subtracting total liabilities from total assets, stand at a staggering $2.42 billion. That's a lot of financial muscle, my friends. But what really caught my eye were those two key metrics at the bottom, a net asset value, NAV, per unit of $1.21 and an adjusted NAV per unit of $1.18. These numbers give us a glimpse into the company's intrinsic value and potential for growth. So, what does all this mean for investors like us? Well, a strong balance sheet like this one suggests a financially healthy company with the potential for long-term success. Of course, we'll need to dig deeper into other financial statements and industry trends, but this balance sheet is definitely a promising start. Slide 7. First, let's examine the debt profile. With a total debt of $2,015.7 million as of September 2023, the company maintains a moderate gearing ratio of 42.4%. This level of leverage suggests a prudent approach to financing operations, striking a balance between risk and potential growth opportunities. Now, let's talk about the cost of debt. The average cost of debt stands at a reasonable 3.55%, indicating that the company has secured favorable borrowing terms. This bodes well for their ability to service debt obligations efficiently. Delving deeper, we notice that the majority of the funding sources are SGD loans at 72%, followed by fixed-rate bonds at 82% and floating-rate bonds at 18%. This diversified debt structure helps mitigate interest rate risks and provides flexibility in managing financial obligations. But wait, there's more. The slide also illustrates the impact of interest rate changes on the company's distributions. A 50 basis point increase in the variable rate would result in a 1.5 increase in the distribution per unit, DPU, for SGD loans, while a similar increase would lead to a 1.2% increase in the DPU for RMB loans. This information is crucial for investors to understand the potential implications of interest rate fluctuations on their returns. Overall, the slide paints a picture of a company with a healthy financial position, characterized by a moderate debt level, favorable borrowing costs, and a diversified funding structure. However, as always, it's essential to conduct thorough research and consider your investment goals and risk tolerance before making any decisions. All right, folks, we've covered a lot of ground today, from CapitaLand's growth trajectory to their financial position and portfolio strategy. I hope this deep dive has given you a better understanding of how this real estate powerhouse is navigating the Chinese market and positioning itself for long-term success. Now, if you found this analysis insightful and want to stay up to date with the latest investment trends and financial wisdom, do me a solid and smash that like button. And while you're at it, hit that subscribe button too, so you never miss out on future episodes of the Investing Iguana. Remember, the road to financial freedom is paved with knowledge and smart investments. So keep learning, keep growing, and keep that money mindset strong. Until next time, this is Iggy signing off. Peace.